Hello, investors. Happy Friday to you. You have got Colby, the DGI Crab here. Thank you so much for tuning in to my favorite video to record each and every week, where we're going to go over each of the stock groupings in tier 1 through 4, which are tiers broken down by age, covering only the 60 of the highest quality growth stocks that I have selected to zero in on for this channel based on age. Before I dive in and explain all of this to you, I will preface everything by saying I'm not a licensed financial advisor, and you should always do your own due diligence before investing in any stock or ETF. The opinions expressed in this video are just one crab's opinion. This is just one crab strategy. I feel very confident in this strategy, and I hope it at the very least gives you some ideas for where you might consider investing your money next week, but don't do it because I told you to do it. Now, let's jump into the tiers. So for those of you that are new to the channel, we're looking here at my spreadsheet. We've got tier 1 through 4. Tier 1 is stocks picked for the 18 to 30-year-old investor, and we're looking specifically at our valuation column here, where we're looking to see how far off the current yield today is from the 4-year average. If we have a green space here, it is 30% or more undervalued by that metric. Yellow is 20 to 29.9, and red is below 20. So here we are again, another week where we've got Nike just sitting up here at the top of the charts. DGI Crab, you're not going to tell me to keep putting money in Nike, are you? Well, listen, you can do whatever you want with your money. I'm not here to tell you what to do. This is all about what I am doing and what I would be doing depending on what my age would be. So of the stocks, the 16 stocks here in the tier 1, the only screaming valuation is Nike, and it remains the most undervalued stock by my metrics of all 4 tiers. Currently yielding, as of the close of the markets here on a Friday, July 26th, 2.04%. The 4-year average is 1.04, 96% off. So I update this 4-year average every Friday, every single week. A lot of the times we're only talking about a basis point of change. When we first started this channel and doing this just a few short Fridays ago, the 4-year average yield on Nike was 1.02. It's up to 1.04. So the longer Nike stays down here in the 70s, the more this 4-year average yield will tick up. But at the rate that we're going, Nike in the 70s is going to be, in my opinion, a fantastic ad for the remainder of the calendar year. So the longer it stays down here, it's not doom and gloom. This is good news. This is what dividend growth stock investing is about. You find a blue chip company like Nike trading at wildly low prices, and you just kind of hope that it stays down there for a while so you have more time to add to your position and build it up. If Nike went down into the 70s, stayed there for a week or two, and then shot back up to $100 a share, you wouldn't have had a whole lot of time to build much of a position up in Nike. So just enjoy it while it's down here. I don't know when Nike recovers, but I would imagine that at some point within the next 6 months, 12 months, maybe even a couple of years, if you're sitting there piling up a nice position in Nike, you're going to look back at this point in time when you were doing it in the $70 range, and you're going to have a big smile on your face because you're acquiring a 2% yield on cost. You're getting year-over-year dividend growth averaging 10 to 11% a year. That is a very nice dividend combo factor for anyone 30 and below. Not a ton of value here, although Visa, which is in my top 10 favorite stocks, and I'm going to cover that a little bit here today. I've got a separate tab just for the top 10. Any of those get into the 20% or better range, I typically start adding myself. Visa had a crash after missing earnings for Q3. They dropped down into the mid 250s. They recovered a little bit here today, but even at 19.6% off, Visa is such a massive dividend growth compounder that anytime that you can get it even at 20% off, I think it's a pretty ideal time to do so. Waste Management, by the way, had a massive fall over the last day or two. They were up over $210 a share. They've fallen all the way down to $196. Are they a buy right now? Well, not necessarily to me. I think they were just remarkably overvalued, and the market is correcting that a bit. So I'm going to be patient there, much as I like Waste Management, another one of my top 10 favorites. But just because I see something drop 8% over a couple days doesn't necessarily mean it is an instant ad. We've got to zoom out, look at the last 4 years of history, and put that context into perspective. Moving on to tier 2 for the age 31 to 41-year-old investors, Starbucks back on top again, 50% undervalued. Starbucks recovered for a bit last Friday when what an investment group, Elliott, they're called, invested a lot of money into Starbucks. It crashed back down this weekend below 75 after nearly hitting $80 on Friday. I still think that this is a fine deal as well. You're getting Starbucks yielding more than 3% when the 4-year average yield is just 2.04. Another blue chip company. Really, all of these companies in this group of 60 are blue chip, but Starbucks just definitely having a rough year this year, and certainly plenty to like here in the $74 range. You can get a full extra percent of yield on your Starbucks purchases at these prices. I think that's a great place to start up. Hershey, taking up a little bit, trying to get closer to that $200 range, but still quite undervalued here in my estimation, yielding 2.83% with the 4-year average at $196. And then Target, below $150, definitely looks appealing. The yield's still above 3%. Target's been kind of trying to recover over the last couple of weeks, just hasn't gotten quite enough momentum yet. And then McCormick, which we've been adding for the last few weeks, has recovered enough that I'm actually going to pump the brakes on that a little bit. I'd like to see it fall back down below 75 before I add any more to my position. But it's definitely one that I was happy to be adding when it was down in the low 70s, and it's nice to see them recovering a bit. And then McDonald's, another top 10 stock pick for me in the 20% or better range. I'm more than happy to add McDonald's anytime we get to this 20% number here. 4-year average yield of 2.2% at 252 even. It's yielding 2.65. Plenty good enough of a value for me at that point in time. And then just a quick note, American States Water was one we were adding just a few weeks ago. It was down in the mid to low 70s. They've recovered pretty nicely. All right, tier 3 for the 42 to 53-year-old investors. Not a ton of changes here for you all. Hormel Foods still sitting up here at the top. Hormel was threatening to drop below $30 a share just a couple of weeks ago. So if you were adding down in the 30 and a quarter, 30.50 range, you've already seen a price recovery of 5% or better. Still, though, yielding 3.53%. I definitely like Hormel at these prices. Going through a tough stretch here this year, the 4-year average yield has been kind of gradually creeping up. So if this starts to become more of a norm for Hormel than an aberration, then the valuation will start to get less and less appealing the longer it's in this range. But for right now, it definitely looks like it's a boring stock with exciting upside. And then Medtronic and Archer Daniels Midland remain our second and third here. They were both just a fraction of a percent below the 30 line last week, and there hasn't really been a ton of movement on either. So Medtronic and Archer Daniels Midland are still fine companies to continue to build up a position in. You're getting well above 3% yield on these when they typically yield in the mid 2s respectively. So a lot to like there. And then let's see, a big mover this week, T. Rowe Price kind of had a hard week. They're starting to creep a little bit closer up into the buy range, but This has been kind of a rough stretch for T. Rowe Price over the last year and a half. Love the company. That's why they're on the list here. And I'm going to keep an eye on them because if they drop back down to 52-week lows, down into the $90 range, then they're going to get really appealing as well. So kind of keep your eyes out on what's going on here with T. Rowe. And then for our tier 4 investors aged 54 and up, still trying to find some value here for you guys, but just another week going by and nothing even in the 20% undervalued. Now, Verizon has actually, at least temporarily, dethroned Realty Income in the top slot here. It's been the Realty Income show for tier 4 for about a month now. And Verizon is not necessarily crashing in price. It's just Realty Income has been recovering in price. So that's sort of the main reason why that's taken place. Listen, Verizon is a stock that doesn't get very many people excited. There's certainly concern with the debt load that Verizon carries, but they are so remarkably stable. They've been increasing their dividend for 19 years. It's very consistently about a 2% increase, which is a snooze. And, when they were yielding 4.5% a few years ago and were overvalued in my estimation, 4.5% yield with a 2% growth rate does nothing for me. But a 6.63% yield starting off is a little bit more appealing. Now, I would like them to get cheaper than this, but it is qualified dividend income, so it's tax advantaged. It pays out on the second month of every quarter. So if you're looking to beef up the amount of dividends that you get paid in those months, Verizon's certainly not a terrible choice. Just would like them to get a little bit cheaper. I think our 54 and up are going to focus more on ETFs again. Here's the tab for the top 10 stocks on my personal list. These are my 10 favorites. If I could only invest in 10 stocks, the only one at the 20% or better mark, again, is McDonald's. But Visa eclipsed that in the middle of the week, and if they drop down really just below like 259, they're going to be right there as well. Definitely love these two stocks. Not a ton of value on the rest of them right now, but I thought I'd just give them their own tab just so we could take a little look at them and see what they're up to. So now let's take a look and talk about just strategy and how I would allocate money with prices at these levels. I'm not telling you to do this. This is just how I would do it following my plan. All right. So for tier 1, if I was 30 or younger, I'd allocate half of my income that I'm putting into the market into 4 ETFs. So I'm going to go 25% S&P 500, 15% small cap, 5% dividend growth, 5% international. And then for those single stocks, I'd allocate about 35% to Nike, 10 to Visa, and then I'd actually jump up into tier 2 since I've got a stock that has 50% undervaluation, and I'd just throw a little 5%er at Starbucks. For the tier 2 folks, this is my age range personally. It's 25% dividend appreciation, 15% S&P, 5% small cap, 5% international. The allocation here on the stocks would be 15% Starbucks, 10% Hershey, 10% into Nike, 5% Target, 5% Visa, 5% McDonald's. For tier 3, I'd go with dividend-focused ETFs, 20% each to VYM and SCHD, 5% to DHS, the monthly payer, and 5% international. This group would be getting 20% Hormel, 10 each to Medtronic and ADM, and then dipping down even 5% Starbucks, 5% Nike, get some little bit lower yield for that group, but higher growth. And then for tier 4, I'm just not going to mess with any of these individual stocks. If you wanted to throw a 5%er at Starbucks and get the 3% plus yield with the nice growth on it, then sure. But I'd probably be sticking to the 8 high yield ETFs that I've picked out for that particular group. And that's my first 50%, and then I'd throw a 30% extra on top of the monthly payer DHS and 15% off of the high yield bonds, which seemed to be a good deal. So that's the breakdown. Happy Friday, everybody. Check the links to videos in the description below, and I'll see you